Hello, and welcome to our fourth quarter strategy review. We met last Friday via Zoom again, but we hope that you all are getting the most out of it because we are able to get each one of us talking separately, but then we're piecing it all together. So, again, we talked about everything as usual. But remember, when we meet next time, we will, in fact, have the election behind us. So the election was a very large topic. And of course, we also talked about how the markets are reacting to the election and the election news. And while I don't think anyone, ourselves included, can determine, number one, really who's going to win, and more importantly, what their economic policies are going to be, that is what occupied most of our time at the meeting, as I'm sure it's occupying most of all of you at this time. At the meeting was Andy Leckel. Andy has met with us before. He is the president of Eagle Harbor Asset Management, and he manages individual assets for people. We do want to say thank you to him. His input was invaluable to help us in making the changes and the decisions that we made. Of course, also with us was Len Skina. Len, of course, is the CEO and Vice President at SR Schillen Associates, and Bob Toomey, our Research Director, also Vice President, SR Schillen Associates. So without any further ado, I'm going to give it to Bob to talk about the equity markets, which we know is on everybody's mind these days. Go ahead, Bob.
Great. Thanks a lot, Stan. So in post our deliberations of last Friday, I would just want to say that we continue to remain positive on equities in general. In fact, coming out of the meeting, we actually raised our average allocation to equities by about 4%, while also decreasing slightly our allocation towards bonds. The primary increase in equities was actually in international. Our international exposure as on average increased more so than our U.S. exposure. So, and the reason for that is we do feel that international stocks do offer somewhat better risk reward and better value at this point. I'd like to point out a couple of things. You may have read my research director monthly that we put out early in September, in which I talked about the possibility of a 10% correction. Well, we had that. It was down about the S&P was down about 11% in the month of September. It's now recovering from that decline. But I just wanted to emphasize, people get the point really being people get concerned about volatility, and I would have to put the the recent correction here in September certainly well within the normal realm of volatility. That a 10% correction is totally normal in the long term, day-to-day variability of the market, and I would not be overly concerned about that. The other thing I'd want to point out is the market does seem to be discounting what we would consider a V-shaped recovery in the economy. The improvement in the market, or the recovery in the stock market since the bear market we had in March is amazing, and as I've said before, has surprised a lot of people. And so I think what you've been seeing in the last couple of months, the September correction notwithstanding, is more money, sort of institutional money, dribbling in off the sidelines that had been parked for quite a while in complete sort of denial that there could be an economic recovery. Now that said, the tenor and the tone of the recovery remains to be seen. There are still sectors of the economy that are struggling mightily, and we think that while we've seen this spring back in the stock market, a slower, more delayed or halting recovery going forward into the winter months, and a potential spike in COVID cases in the flu season, which they're talking about, we think could impart some increased volatility going into the fall and into the winter. With respect to the presidential election, as Stan mentioned, we did talk about that at length. I think in the end, our belief is that whoever wins that, we don't necessarily see a dramatic change in policies that would derail or dramatically change the long-term growth in corporate profits, which are the primary driver of stock prices. There's been talk about the Biden presidency potentially raising corporate interest rates back to where they were pre-Trump. Companies are very creative and very resilient, and we think that the markets would adjust fairly quickly to something like that. The last point I'd make is that we do see the markets broadening out in terms of leadership. Leadership, as you know, has been driven largely by what we call these very high valuation tech stocks. We are starting to see some broadening out into other sectors such as industrials, materials, other cyclicals, and we think this is a healthy development for the market. And we did make some changes in our holdings that I'll talk about later. Take advantage of that. So with those comments, I'll turn that over to Len now for talking about, give us some insights on fixed income.
Thank you, Bob. The bond area is a challenging area right now as interest rates are so extraordinarily low. They're at such historic lows right now that they basically have almost nowhere to move but up. We do not see the Fed actually moving them. In fact, the Fed has made it very clear that they do not want to raise interest rates. Now, the Fed can only control the short end of the curve. They do not control the long end of the curve, but the long end of the curve is staying low as well. If there's any risk anywhere, it would be a slight move to the upside as far as we're concerned. But we really don't see interest rates doing much of anything. That leaves us in a position where fixed income is really just not returning a whole lot, because the rates that you're getting on the bonds that you're holding just aren't very, very high. We have supplemented for a couple of quarters now, and we are continuing to do it this quarter, the intermediate term bond area with a global or international bond fund that is increasing the rate of interest that you're getting, the yield that you're overall getting in that particular area of the portfolio. And it is doing it in such a way that we're getting significantly higher yields for that component without introducing anywhere near as much risk as we would have to introduce if we were going into something like a high yield fund. That is a benefit that we have continued for this quarter. We see it as being a good place to be, and that's really the major change overall in the bond area, is that we've just lowered our overall allocation to the fixed income area as we favor equities more now. With that, I'm going to turn it over to Stan to talk about REITs.
Thanks, Len. REITs have always been a stalwart part of our portfolio, but as you've been listening to us quarter by quarter, we have been more and more concerned about two of the three legs of the REIT stool. One of them being large office buildings and the other being large shopping centers. While REITs continue to throw off a high degree of dividends because they are a pass-through vehicle, and we like that, we have been moving away from the traditional REITs, and we have purchased medical REITs, and we've also purchased Prologis, which is more of an industrial REIT. Again, in an attempt to soften any blow that we might have to the large office building and frankly, the large shopping center area of the REIT portfolio. We have found that there has been some benefit to those moves, but we have found that medical properties, frankly, to our surprise, has not been a positive move. So you will see when Bob tells us about our changes We are still committing to REITs. We have cut the commitment down somewhat, and we are removing the medical properties, but keeping the industrial side. So again, continue to like REITs, like the overall investment return, but we are somewhat concerned, so we have cut our exposure somewhat. And with that, I'm going to turn it back over to Len.
Thank you, Stan. I'd like to talk to you a little bit about the international side of things. On the international front, we have for a while been only in the developed markets, and that's a change that we're making this quarter, is to move not only into developed markets, but to take a portion of that international allocation that we have and put it into the emerging market fund. The emerging markets at this point are in a position that we believe are a good time for us to be getting in. We do believe that they are in an area or a better situation to possibly outperform going forward. And we've actually overweighted ourselves more towards the international area from where we were, because we frankly do see the international area being better positioned, both in terms of valuation and in terms of just not being subject to some of the craziness that we anticipate in terms of volatility in this coming quarter, given all of the nutty things going on in the US elections. The international area will be, I don't want to say immune from that, but they will be significantly less impacted by any of that kind of thing. And we believe that that's an area that is worth putting a little bit more into right now. With that, I'd like to turn it over to Bob to talk about other changes in our model.
Thanks so much, Len. I'm happy to give a quick rundown on some of the changes to our holdings this quarter. As I mentioned earlier, our average equity position is up about 4%. And that is because we are still positive on equities. We think that the longer term trend for the economy is good, and that growth in the economy and corporate earnings should support higher stock prices, along with, of course, a extremely accommodative Federal Reserve, which is applying a maximum liquidity to the system, and that is also positive for equities. The primary source of increase in our equity exposure came from international. This quarter, we have added to our allocation there slightly because we feel that there's relatively better value in that sector. And as I mentioned earlier, our fixed income exposure is down about 8% on average, largely because we feel that returns are, longer term returns in bonds look very poor at the moment. With respect to a couple of holdings that I'm going to highlight right now, we are retaining our position in the VanEck large retail company ETF. RTH is the symbol on that. We think that that does hold Amazon, Costco, Walmart, Home Depot. So we think that, those we would consider stalwart companies that we feel are well positioned to continue to grow in a good economy or improving economy. We also added this quarter an ETF that I think is very interesting and very, very positive addition to the models, and that is the VanEck Wide Moat Company ETF. The ticker symbol there is MOAT, and this company holds this ETF, holds companies that are rated by the Morningstar analysts. So there's a fundamental element to this that I think is quite positive. And also, this ETF holds large, high-quality companies, most of them dividend paying, but many of them they call moat because they have very high moat or strong competitive positions. And I think that these are good additions to the model because these tend to be lower valuation stocks, and I believe offer an element of risk mitigation, of valuation risk when you look at some of the larger cap, the cap weighted indexes that are in the model, like SPLG, which have been heavily influenced by the very high valuations for technology stocks. As Len mentioned, in the international sector, we did add a small position in emerging markets. We believe that EM also offers a relatively positive risk reward because of their valuations, and also because we believe that EM would be more leveraged in a global economic recovery to the upside versus Europe or Africa or South America. And we think that emerging market economies again would be better leveraged in a improving global economy over the next year or two. So with those brief comments, I'll turn it back to Stan for his closing comments and observations.
Thanks, Bob. And as you can see, we certainly had a lot to look at between elections and fiscal policy and COVID pandemic and all of the things that are on all of our minds. But you heard each one of us really being fairly positive. And that is primarily because we believe that staying the course is an important part of what we bring to the table to help you not panic in crazy situations. With that, I'd like to put up a chart, and I'm going to leave it up there for a minute and not talk. I hope you've all had a chance to see it. It just shows that if you get out of the market, then you miss what happens in the market. That chart, and again, graphically displays what happens if you missed the 25 best days of the market since our firm started in 1987. That blue line is the growth of $10,000 compared to the same index, the S&P 500, if you missed the best 25 days. And remember, we're not talking about a short period. We're talking about 33 years. That's how long this firm has been helping our clients not panic when things get rough. At any rate, looking forward to meeting with you again next year. We will have a lot of answers to the questions that we asked today. And again, we are looking forward to a relatively positive quarter, regardless of all of what's going on. So thanks for tuning in. Remember, you can look at each one of these quarterly reviews that we've had on our website, and we'll hopefully see you again next year.